what's your current assessment of the global economy and financial markets?
Well, we're back to hopium. I think what happened, and I think this is really critical to understand from a both macro and technical perspective, where did we come from? In September, October, we had obviously market volatility. We had new lows in markets, and this was the point where I think we also had peak bearishness in general assessment of the economy and in markets, as yields and dollars had reached really uncomfortable levels. Uncomfortable in terms of the 10-year was, heading towards the 2008 levels. The dollar had ripped higher the entire year, and all that had obviously pressured asset classes across the globe. And it was the tightening. It was, from a market perspective, the major tightening that we've seen in this cycle. And it was right around that time in October when we also started seeing cracks in the system in terms of liquidity. This is the moment when we saw the Bank of Japan intervening. That's when we saw the Bank of England intervening. They all had their own pockets of angst of things falling apart. And that was also the time when Janet Yellen came out and was also getting concerned about liquidity in the treasury market. And folks, that was it. That was when the VIX was done. And since then, and so it's really critical for everyone to understand, this is when, from a market perspective, we saw the peak in tightening. The dollar reversed of a multi-year trend line. The bond yields all reversed dramatically. And lo and behold, equities rose hard from very key technical support levels in context of a bear market. And this is really critical. It's been critical for me all year last year and into this year, is what appeared to be the most controlled bear market ever. We had individual companies, as probably all of you know, blow up left, right, and center. I mean, the drawdowns and the ARKs, the Teslas, the Amazons, Facebook, you name it, crypto, Bitcoin, all of it got hit hard, like we saw in the 2000 tech bubble reversion. In fact, some of the signal charts that we saw were so oversold and so negative, so persistently negative, they rivaled what we saw in 2008. It was fascinating to see. We didn't have the drawdowns that we had of 2008. But this all came together at the same time, which was to say, wow, we're in, actually, technically speaking, in a major, major event situation. Yet, volatility didn't play ball at all. The VIX last year made lower highs, consecutive lower highs with every S&P low. So something didn't smell right. This is when I started, and I got reamed over it at the time when I started flipping bullish, because here's the bear going bullish in a bear market. What an idiot, right? But all the technicals lined up, and then we had the reversals in the dollar and yields, which were absolutely necessary. And what has happened as a result of this is that financial conditions have eased consistently, persistently since October, radically eased. And that's why we saw this big equity rally. Then we had, obviously, tax loss selling in late December as people had taken care of their losses throughout the year. That's not unusual either. But even in December, the technicals were lining up for something bullish. I tweeted out this potential cup and handle pattern, which is, it held at the 23.5, which was kind of a key level of support. And boom, we got this, along with China reopening, which I think is a really important point from a macro perspective as well. Keep in mind, China intervened as well. They added to liquidity. So all of a sudden, global liquidity, which is supposed to be in this really aggressive tightening path, on a net basis actually went positive, right? And boom, what do you have? You have a major melt up in equities that were oversold, technical basis, oversold from a tax loss selling perspective. And boom. And so now fast forward to here, you come from an extreme oversold market condition to now moving towards key resistance levels. This is what happened here in early February. And along with this, and this is also typical for any larger bear market, is obviously you get that moment of relief. Price drives sentiment. And right, all of a sudden, because the price action is so good, and everything is looking maybe perhaps better because easing financial conditions have consequences, right? You start getting the wealth effect again. People start feeling better, right? If people were previously bearish, which they were, because we just saw about $300 billion in short positioning covered here into February, that's when people question their own narratives again. It's kind of the classic pain trade type scenario where you have either shorts that are bearish or you have underinvested longs that get ripped higher. They're getting forced to cover. And lo and behold, everybody's talking soft landing again. The big shocker to me here, just from observing the central bank space in the last couple of weeks, was Jay Powell absolutely steadfastly refusing to acknowledge the dramatic easing in financial conditions we have seen and insisting that financial conditions have tightened significantly.
Can you explain that?
I suspect that the Fed kind of sheepishly, I got the impression through the various mouth organs on Twitter, tried to say that maybe they're looking at some sort of narrow definition of what that means. They have been raising rates, but if I see raising rates and yields dropping like a brick and mortgages dropping and financial conditions, look at the Bloomberg index, even the St. Louis's own US financial conditions index has dropped off. That's not tightening financial conditions. That's easing financial conditions. That's why you see the related reaction in equity markets. I think I posted a chart on this the other day on Twitter, which was that the St. Louis US Financial Conditions Index never even got to restrictive. It basically just tacked a neutral line at one point and now has reversed back to easing, which is a really odd way to present yourself on the one hand as, you know, we're going to be Volcker. Remember, that was the Jackson Hole speech from August. And we're not going to be Arthur Burns from the 70s, you know, to stop and go and have to redo it, to now basically saying, okay, now let's talk about disinflation nonstop, because that's what Powell did during the FOMC conference. I think he mentioned it 10, 11 times, which in context of financial conditions never having really tightened seems an odd strategy to ultimately declare victory on inflation. Now, personally, I've been on the record saying that I expect inflation to come down dramatically, and the raising of rates, as aggressive as they have been after they were caught flat-footed and had to catch up, was the right thing to do. The question, though, is going to the larger macro in terms of soft landing narrative now, is we are the math reality. We are witnessing the most aggressive rate hike cycle in 40 years into the highest debt construct ever. And this debt construct, you and I have been talking about this for years, has been building ever more aggressively so. And of course, the COVID crisis was not helpful in that regard. What happened prior to all the administrations was not helpful at all. The issue is obviously we were all able to afford all this, corporations, governments, personal consumers, with rates being low, being at zero. You can run all kinds of debt in that context. But now the game's changed. I mentioned earlier the 10-year yield going up to 2008 levels. In 2008, that GDP was 60%. Now it's 120%. This is a completely different economy. And the Fed, having raised so quickly, does not know and cannot claim to know what the lag effects are. Lag effects in raising rates is a well-acknowledged fact. Central bank policy works in lag time period, okay? So whatever they did here in the last 6 months of 2022, we won't see the full effects until the middle of this year, later this year. That's the big unknown. I saw Goldman came out yesterday and said, oh, the economy is poised to handle higher for longer, maybe better than we expected. No one knows. It's a guess. It's an estimate at best. That's the danger that we're all confronted with. We are in a way dealing with unknown circumstances.
Yeah. And Sven, if I can just add into that, from what I heard from Powell, he mentioned that several times in his speech. He talked about the lag effect, and markets just totally seem to shrug it off.
Keep in mind, it's not only technical stuff and the easing financial conditions that have been driving it, it's the positioning as well. Sentiment is so important in this. I mentioned the $300 billion in short covering. You get moves like this in major bear markets. I mean, actually what we're seeing now is child's play compared to what we saw in the year 2000. I mean, we had even much more aggressive rallies, 30, 40, 50, 60% on some levels on the NASDAQ, for example. Absolutely insane. I cannot say how this will play out. There is maybe a chance for a soft landing. Keep in mind, China reopening, I think from a macro perspective, is a big deal. I think we have to respect strength. I saw the FTSE making new all-time highs this week. I saw the DAX had amazing recovery. In fact, the DAX was one of those indicators one had to pay attention to, because that thing started breaking out of a technical descending wedge in October, and it ripped and ripped and ripped. And US indices followed suit one by one by one, the NYSE, the Dow, then ultimately the S&P and the NASDAQ, which was lagging. We have seen technically very bullish action, and that so far remains bullish. And so you have to, if you have a particular macro view, but ignore the technicals at the same time, you're going to get run over